My name is Nur Syafiqah Adriana binti Sharif. My metric number is D2022110303. Now I would like to tell about executive summary and the introduction for this case. The case that we pick is the Satyam Computer Services scandal, often called Indian Enron, was a massive corporate fraud exposed in 2009. The company's founder, Ramalinga Raju, admitted to inflating revenues and assets by nearly 7,000 crore, misleading stakeholders and regulators for years. This exposed severe governance failure, weak internal control, and audit negligence. The scandal shocked investor confidence and damaged the reputation of India's corporate sector. In response, the Indian government replaced the board and facilitated the company's takeover by Tech Mahindra. The case led to major reform in corporate governance, include new rules under the Companies Act and stricter auditing standards. It highlights the importance of ethics, accountability, and strong internal controls in modern business. Satyam Computer Service, founded by B. Ramalinga Raju in 1987, grew into one of India's top IT and BPO companies. Headquartered in Hyderabad, it served global clients including Fortune 500 firms and was listed on NSE, BSE and also NYSE. However, in January 2009, Satyam became the center of India's biggest corporate fraud. Raju admitted to falsifying the company's financial records for years, overstating profit and asset by nearly 1.5 billion. The fraud came to light after Satyam attempt to buy Mitas Infra and Mitas Properties, companies owned by Raju's family, using fake surplus cash. This move triggered investor outrage and investigation. As a result, Satyam's stock collapsed and criminal charges were filed. The Indian government dissolved the board and Tech Mahindra eventually took over the company. This case highlights major failure in risk governance, internal control, and also auditor oversight. Internal and external auditor, along with the board, failed to detect or prevent the fraud. The Satyam scandals served as a critical lesson on the importance of strong corporate governance, transparency, and also accountability, especially in rapidly growing markets.
Risk governance analysis. A. Corporate governance structure. First, way oversight. Satyam appeared to follow international governance standards with an independent board and audit committee. However, these were merely a front to hide fraud. Second, board failure. The board, especially independent director, failed to challenge management or detect systemic fraud due to a lack of field, expertise or independence. Third, audit commit blind spot. This commit, meaning to oversee financial, failed to question inflate cash, fictitious revenue or ghost employees, indicating a total breakdown in risk oversight. Then, ineffective internal audit. Internal audit mechanism were either bypass compromise or to prevent the manipulation of system and data. Then, no real risk management. There was no independent chief risk officer or effective risk commit, showing risk management was just a compliance formality, not a strategic priority. And CEO unchecked power. The CEO unchecked authority and others' negligence completely undermined risk governance. Stakeholder expectation. The first one is mislead investor. Raju inflated figure to maintain a high stock price, misleading investor. The failed Mitas acquisition meant to hide fraud lead to immediate investor backlash. Second, plummeting investor confidence. Raju confession caused a massive stock price collapse and class action lawsuits in the US. Then, customer concern. Customer like the World Bank raised concern about continuity and data security. Some even suspended or cancelled project. And then, auditor accountability professional service network (PwC), despite claiming reliance on management information, faced instant scrutiny, regulatory action, and significant reputational and legal consequences for their complicity or negligence. Then, regulatory intervention. Initially slow, SEBI and MCA reacted strongly post-confession. The government quickly replaced Satyam board to protect stakeholders, stabilize the company and safeguard India's IT sector reputation. Type of risk involved. The first one is financial fraud risk over ration rice. Deliberate manipulation of financial statements with fake invoice, fictitious deposit and dummy employee accounts. This fraud was concealed for years and only exposed by a failed acquisition and Raju confession, not internet controls. Second, reputational risk. Severe damage to Satyam image and India corporate governance, evident in stock crash, lost contracts and public outreach. Addressed by government intervention and acquisition by Tish Mahindra. Next, governance and compliance risk. Failure of the governance structure with board compromise audit command, overriding controls to ensure ethics and transparency. This allowed the fraud to persist, leading to non-compliance with accounting and regulatory standards, led to post-scandal reforms. Governance response. The first one is board supervision. The Indian government immediately dissolved the existing board and appointed a new, credible one to stabilize the company and facilitate its sale. Second, forensic audit and investigation. Multiple agencies like SFIO, SEBI and CBI launched extensive investigation and forensic audits to uncover the full fraud. Next, legal prosecution. Raju and other case individuals face criminal prosecution and PwC Indians Arm also face penalties. Next, facilitated acquisition. The new board successfully auctioned Samyam to Tish Mahindra, ensure business continuity, protect jobs and mitigating broader industry impact.
Hi, my name is Nur Nadia. Next, I want to present lesson learned. First is corporate governance must go beyond formal structure. Despite having a board and audit committee, Satyam failed due to lack of diligence and independence. Second is ethical leadership is essential. Fraud at the top level showed how unethical leaders can destroy an entire organization. Third is auditor independence is critical. External auditors failed to detect fraud, highlight the need for regular review and auditor rotation. Fourth is risk management must be proactive. Satyam lacked strong risk oversight, allowing manipulation to go undetected. While for the recommendation, boards should be independent, qualified, and actively oversight management. Next is auditor integrity must be ensured with rotation and non-audit services. Next is avoid concentrating power in one executive and using deceptive accounting.
Hello, my name is Nurul Sakira binti Zamri and I will present this part which is impact and outcome. In this section, we look at what happened after the Satyam scandal, which is sometimes called India Enron. The company founder admitted to making profits seem higher than they really were. This caused the value of the company share to drop a lot, and the company lost over 19% of its value very quickly. This made investors lose trust in Satyam and in India's business world. Auditor like PwC, whose job is to make sure everything is above board, didn't spot the fraud. This has raised serious questions about how reliable financial reporting and audited practices were at the time. The Indian government did not wait and took quick action. They replaced the board, start legal action and help Tech Mahindra take over. This saved thousands of jobs and helped people have faith in the industry again. The long-term result of the investigation was that those found guilty were sent to prison. There were changes to the rule and it became compulsory for auditors to check regularly to stop future dishonesty.
The last one is conclusion. The Satyam scandal revealed major failures in corporate governance and risk management caused by lack of integrity at the top level. Despite having formal structures, weak internal controls allowed fraud to occur. The case led to investor losses and damaged the reputation of India's IT sector. In response, the government intervened and reforms like the Companies Act 2013 were introduced. This scandal shows that ethical leadership, transparency, and strong risk management must be part of corporate strategy, not just compliance, to protect long-term trust and sustainability.